Namaste, welcome to Arthaniti. Today, let us discuss debt instruments, fixed interest earning securities. Should you invest in debt instruments? What should be the ideal choice of debt investments? And what should be the period for which you should invest in these instruments looking at the current market scenarios? Let's discuss. Let us try and answer these questions one by one. So, at the beginning, what is a debt instrument? Well, when companies and government borrow money, they issue debt instruments. When we invest a lump sum amount of money in these investments, the borrower, that is the company or the government, promises to repay back the money to us at a fixed date in future, maturity date as it is called. It also promises to pay an interest which is at a pre-decided rate for using our money. Correct? This fixed return that debt instruments offer lures many people to investing in such kinds of instruments. Now, the various examples of debt instruments can be bonds, debentures, corporate or government bonds, fixed deposits offered by corporates, banks, all form part of debt investments. Now, when or why should one invest in a debt instrument? Well, investment in debts is done to protect your capital. So, safety should be your top priority when you are investing in a debt instrument. Are bank FDs good enough for long term investing then? Or should people go for other debt instruments? Well, SBI, State Bank of India, the largest bank in the country, is offering interest rates ranging from 5 to 6.20 depending on the age of the depositor, which is very low given the inflation at 6.7%. So after tax, the returns that you get from your FDs will not help you beat inflation. When it comes to corporate FDs, many housing finance companies or non-banking financial companies offer corporate FDs. Companies like Bajaj Finance offer a good enough rate of 7.25%. HDFC, on the other hand, offers 6.90%. Again, these are for senior citizens where people below 60 years of age will get a lower rate than what I have quoted. Now, before investing in these FDs, you should know a few things. Corporate FDs are not backed by any insurance. Like in banks, depositors are insured up to 5 lakhs of rupees for their principal and interest by Deposit Insurance and Credit Guarantee Corporation, which is a subsidiary of RBI. In corporate FDs, no such insurance is available. So basically, there is a risk involved when you are parking your money in corporate FDs. Second thing is, these FDs and the prices of these FDs, the interest rates are based on ratings done by rating agencies like CRISIL, ICRA, or S&P, Fitch, Moody's. These are some of the well-known rating agencies around the world. Now, time and again, we have come to know that the ratings of these agencies do not always give the right picture. In case of DHFL, Diwan Housing Finance Limited, the rating for their FDs stood at AAA, which is one of the highest ratings offered by these credit rating agencies, till the time till the time the company defaulted and did not repay back the money to the FD holders. So there is a big question mark about the rating agencies and the kind of ratings that they give to corporate FDs. Now, if you want to know how the rating agencies work, I suggest you check out a movie called The Big Short. It is about the 2008 housing bubble that happened in the US economy and how rating agencies were hand in hand with the banks, which led to this debacle in the US markets. Must watch movie. right now. So how much faith you have in these rating agencies, or how you decide about putting your money in these corporate FDs based on these rating agencies, again has its own deliberations, or a big question mark that you should raise in your mind before taking a decision. Like if you want to invest, and you should invest some of your money in debt instruments. Why am I saying this? Why? Because it forms part of your emergency fund. It forms part of the money that you can use in case the money has to be withdrawn, right? And you have not put it like some capital which needs the safety in case there is a turmoil in the market, or an unforeseen event, say like COVID crops up. You have this money to fall back on. So putting some amount in safety is always advised. So then what are the options? Bank FDs are not giving good enough rate. Corporate FDs come with their own set of risk, but still known corporates with a known track record, say like Bajaj Finance or HDFC, who have been running these FD schemes for quite a long time, should be and can be thought of for parking your funds. Again, this is no recommendation, and you should check and study before you invest your money there. So then what is the way out? Well, when you go for parking your money in debt instruments, being greedy does not help. Looking for higher interest rates should be secondary. As I already told you, safety should be your top priority. So if you want to go for instruments which are going to help you earn better, look out for other options. When you park your money in debt instruments, park it as such for safety of your capital. So bank FDs can be one of the way in which you can park your money in fixed interest earning securities. One more way out is by investing in debt funds. Mutual funds offer varied funds of varied time periods wherein you can put your money in debt instruments. Now, I suggest you go in for mutual fund debt instruments, debt funds, if you are planning to put your money in safety, right? Uh, should you put it for a long term, given the scenario around the world, the inflationary trends, the rising prices on a daily basis? See, normally what happens is during inflation, to like in the near future, or sometime in the near future, the central bank of the country is going to increase the interest rates. Why is it going to do so? Because it wants to suck up the liquidity in the market. Why is that the case? So that demand for goods and services goes down if people don't have money with them, and the prices are again balanced, right? Inflation is about balancing. So whenever the inflation goes beyond the target set by the central bank acts by rising the interest rates in the economy. Now, RBI monetary policy meeting is underway, and it is expected to declare its decision in this week. Whether it rises the interest rates or whether it keeps the interest rates unchanged in this meeting, it is bound to hike rates in the near future. Why? Because of the inflationary trends in India, as you see around the world. Now, in scenarios where the expectations is that the interest rates are going to go up, it is always advised that you do not park your money in fixed interest earning securities for a long term period. Again, the question that should come up in your mind is, why is she saying that? Why? Because if the RBI decides, if and when the RBI decides to rise the interest rates, you should not like be you should not be left out by taking advantage of the rising interest rates. If you have locked your money for a longer period of time, you will lose out in getting this benefit when the interest rates rise because of RBI decisions. So, in scenarios where the expectations are such that the interest rates in the economy are going to increase, you should always park your money in short term to medium term debt instruments. Why? So that you can take advantage of rising interest rates. Correct? So, I hope I have added value to your investment journey today, and why it is important to put your money in debt instruments. Again, which kind of debt instruments should you choose, and what should be the time frame which you should look at in the current market scenario. I hope we have answered all the questions, and do ask me questions if you have any on this topic, and I'll be happy to help you, or I'll be happy to answer them to the best of my abilities. Like my video, share my video, subscribe to my YouTube channel, and keep looking for more such informative videos to add to add to your financial literacy. Thank you and goodbye.